Schwab Advisor Services is a proud supporter of the RIA Edge podcast and independent financial advisors like you. When it comes to your independence, Schwab Advisor Services is all in. They provide industry-leading custody services with no AUM minimums, no custody fees, and digital onboarding for starters. With Schwab, you'll be backed by some of the most passionate folks in the industry with over 35 years of experience helping firms of all sizes. To learn more about everything Schwab can do for you, visit advisorservices.schwab.com. Hello, everyone, and welcome to the RIA Edge podcast. As you know, this is my chance to talk with executives at wealth management firms that are committed to growing their businesses in a sustainable and intentional way. As we've long said around here, we want to study RIA growth by design, not by default, and certainly not by simply riding the updraft of market appreciation. In this interview, I got a chance to speak with Nate Lenz, who is the founder and CEO of Concurrent, one of the fastest growing RIAs in the country. Nate spent his formative professional years at Raymond James, where he led the succession planning and acquisition teams. And he's using that experience, I think, to aggressively build Concurrent as a kind of backbone of support for a network of like-minded advisors. A partnership that I think now has some 30 firms in the group. He's definitely a next-gen advisor and brings, I think, a refreshing but still strategic view on the modern RIA ecosystem and what it means to grow a business in that environment. So with that, I think you'll learn a lot. Let's go to the conversation. Thanks for coming by.
Absolutely. Excited to be here.
Yeah, so I think a lot of folks who maybe aren't as familiar, you want to tell us just a little bit about Concurrent and give us the sort of 101, the background. I know you were an OSJ at Raymond James.
Correct.
And now it's transitioned to an RIA.
So we had an interesting progression, right? I actually worked at the Raymond James home office from 2011 to 2016. I ran the succession and acquisitions group there. A lot of the work that we did there informed what we ended up building with Concurrent, originally as the OSJ and now as the RIA. When I initially left Raymond James in 2016, it was not to start Concurrent. We actually started a consulting business, something akin to a succession resource group, FP Transitions, crossed with an external recruiting firm. The idea was to go an inch wide and 100 miles deep with a select group of independent firms that wanted to grow inorganically. Mm-hmm. With that being really my expertise growing up on the practice management, business consulting, M&A side of the house, thought I could add value to independent wealth management firms in that capacity. And what we recognized pretty quickly, I had a partner, Scott Steele, that launched that business with me back in 2016. And what we recognized pretty quickly over that time frame is that a lot of our clients were operating substantially similar models, just in different markets. They had different areas of expertise that they specialized in. But even though they had some scale at that time, most of them were between, call it 300 and 500 million of assets, for them to go out and invest in all of the infrastructure necessary to have a lot of success doing it in a scalable and repeatable manner would have been cost prohibitive. And so we presented this idea in December of 2016. We packed, I think it was 11 or 12 people into a conference room at the Atlanta Airport Marriott Hotel that I think sat 8, so a little bit uncomfortable. And we presented this idea called the superstructure. Maintain your brand identity, your autonomy, but let's jointly invest in a shared infrastructure. Let's scale the scalable. Let's start with the most operational back office functions, and over time, continue to reinvest as we grow in stuff that will actually touch the end client. And ultimately, we hit the ground running. There were 9 firms at the table for that meeting. 9 became 8, 8 became 5. 2 years later, we bought out 2. So we went through the scraped knees and bloodied elbows of how do you operate a business with that many chefs in the kitchen. Mm-hmm. But we finally, I think, hit our stride as an OSJ in 2018, 2019. And that's where we saw a lot of our growth really start to pick up in that capacity. Now, operating as an OSJ, we had the benefit of leveraging, we were on Raymond James's platform. Mm-hmm. We leveraged their broker-dealer, their corporate RIA, and we had the benefit of being able to leverage all of their technology and operational support. So during that time frame, what we really got good at was the practice management, business consulting, assisting our firms in executing on M&A strategies. A lot of the stuff that was core to what we had done initially was we were able to hone that further, right, in that capacity. Ultimately, when we made the move to the RIA space, that required us to backfill a lot of the operational resources. Mm-hmm. So over the last, call it 18 months since we've made that move, it's really involved us building out our base camp operations team, bulking up our resources on the compliance side and technology side and training side to be able to not just leverage a platform, but actually operate a platform. Mm-hmm. And so it feels good now that we're about 18 months in to operating as a fully independent RIA. Now we're refocusing on growth. And I know that's a topic that you like to talk about quite a bit, but it feels good to be able to take a deep breath, know that we've been able to, really, I think, build the infrastructure necessary to continue to scale and to continue to grow. And now we're turning our attention to how do we expand the scope of services our advisors can provide to clients, how do we drive organic growth, and then how do we continue to execute on our core competency of experienced advisor recruiting and M&A.
18 months ago, when you made that transition, left Raymond James, essentially, formed your own RIA. What was the impetus there? What did you see as the opportunity that you could do now that you couldn't do as an OSJ with obviously a larger group of advisors out there for sure that aren't Raymond James? You're multi-custodial. But was there's the personal economics as well, I'm sure, but was there some impetus or opportunity that you saw for, this will work better outside of the Raymond James ecosystem?
Yeah, I think really being able to expand the addressable market for recruiting was an attractive point there. Also, being able to evolve from being captive to a singular platform to becoming an institutional client of the street. One of the things that we preach quite a bit is this idea of independence, not just in business model, 1099 versus W-2, but independence in terms of objectivity of advice. And now that we're multi-custodian, we have both Fidelity and Schwab available on our platform. And we have, I think, the full menu of investment solutions out there to choose from, as well as technology resources. We're able to move across platforms to find the best solutions for clients, leverage competition for our clients' benefits. And so that idea of being able to get to the fully independent space, not just to have a much wider addressable market, because that's what we're experiencing. When we were in OSJ, our primary target advisors were wirehouse breakaways, going independent for the first time, and we would help create that bridge to getting them to the independent space and helping them evolve from practitioner to CEO and helping them tackle things like how they're handling their human capital and how they're evaluating viability of new locations or strategic initiatives. So we, again, got very good at that. Now, ultimately, as we think about the addressable market, we're seeing firms, not just from the wirehouse, we're seeing advisors that are at independent broker-dealers that are looking to take that next step into the RIA space. We're also seeing existing RIAs that are looking to roll down their registration to fold into what we're doing to get the benefit of additional scale and resources. And we're also exploring some really interesting strategic partnerships with RIAs that are even similar in size in some cases to say, hey, how can we come together, share ideas, leverage our collective scale to realize some cost synergies. That addressable market, I think, was the most attractive element of it, but it was very consistent with this concept of helping our advisors gain further and further independence and representing shedding the landlord in some degree, for us. And so I think that was the biggest attraction there.
And so now you're at 60 firms?
54 individual books of business.
Okay.
It's 101 financial advisors, 37 offices, about $8 billion in assets under management, and then about another $11 billion of assets under advisement, primarily in the defined contribution 401k space.
Okay, sure. And how many of those firms came with you from the Raymond James days into the current structure versus how many have?
Yeah, so we've added, since we made the move, we have added about 25 individual advisors. Those are across, I would call it 15 books of business. So I'd say we brought about 39, 40 individual practices came with us from Raymond James, and we've since added those additional teams. The new teams added represent about $2 billion in total assets on the assets under management side. They've been primarily retail focused as opposed to institutional or retirement plan focused.
So you saw a bit of an acceleration in growth since leading the Raymond James ecosystem, and since kind of opening up to.
And we were running at a pretty good growth clip while at Raymond James. So I would say that, we definitely took a step back as we made that move, as we were building the infrastructure to be able to support this new model. But I would say that now, really looking at the second half of last year, we had some really notable teams join. Lumiture Wealth Partners out of Atlanta brought about $700 million of new assets to the table. But I would say that when we think about growth, we're not just focused on asset growth, right? It's also, we want advisors who are passionate about what they do, who are committed to, not only growing their business from a quantitative perspective, but that are looking to grow the services that they can provide to clients, right? And expand the scope of services there, providing more holistic solutions, grow professionally, achieve new designations. We've had a number of teams that have gotten the SEPA designation now that are working with business owner clients. We formed some interesting strategic partnerships with investment banks that serve those types of clients as well. So always focusing on growth, again, not just quantitatively, but really on how they're operating their business, how they're refining their processes, how they're improving, right, what they're able to deliver. That's, I think, as important to us and just creates a virtuous cycle that we'll continue to build upon.
And the firms that you work with, they keep their own Form ADVs, or do they join in your Form?
They all join under our ADV.
Okay.
So all of the advisors on our platform are IARs of Concurrent.
Yep.
We do have a broker-dealer relationship with PKS, so advisors can choose to be hybrid and have both options available to them. And so, one thing that we talk pretty heavily about with teams that are considering joining us. And I think when you look at our model, we've got some interesting dichotomies because our teams have the ability to build their own brand and have autonomy around that. Our belief is that the future of this business is going to continue to be more and more advisor-centric, and that clients are going to gravitate towards advisors who they perceive are like-minded, have shared core values, are best equipped to serve their niche. So we view a big part of our role is to prop that up. That's why our firms can fly under their own flag, even though they're a part of our ADV. And so you'll see a lot of our teams will use the Powered by Concurrent co-branding, and that's so they can tap into the national scale that we have, but still have the bespoke offering locally and create their own local culture. So that's very important to us in upholding that. It goes back to those early days of sitting at that too small conference table where it's, hey, we want to remain true to that founding philosophy of you're going independent for a reason. And we tell teams, you're not joining our firm, we're partnering with you to build yours. So that's really important to us, and I think it manifests itself in the brand autonomy that we provide them.
Sure. We talk to a lot of advisors who are in this, doing something like this, and that balance between efficiency of scale and personalization is always the tricky one, right? Because if you're going to have all the advisors on your platform kind of running their own brands, kind of running their own shops in a way, I'm sure they all have kind of their own independent investment philosophies, their own ways of doing things, their own way of client reporting, their own ways of blah, blah, blah.
Sure.
How do you where do you get efficiency in that kind of, field of personalization?
It's a good question. The blessing and the curse of the majority of our teams coming from Raymond James with us as part of that conversion, we moved about 20,000 accounts in that initial move, is that ultimately, as we were sitting on the independent broker-dealer chassis, we were using the technology from Raymond James end to end. So from that perspective, we were not having to integrate legacy technology stacks. So we had a little bit of a blank slate. We were able to put together and curate a technology offering that we think is best in class. But then ultimately, it was a tall order for us to be able to deploy the training resources to get our advisors up to speed on how to use it, how to get the lift out of it. Because you can have a bunch of different logos on a page, but if it's not actually moving the needle in the business. But what that did, though, is allow us to help inform them on best practices of how to do reporting, right? And then ultimately instituting our billing processes and, being able to execute on financial planning. And we do have an area that we are investing in heavily as we think about this next phase of growth for us and expanding the scope of services is our centralized planning team. And so being able to support advisors from a financial planning standpoint, we think is one, it's a great way to develop talent in the business because this is an apprenticeship business after all. And so if we can bring in new advisors that can operate in that area of specialty, they can ride shotgun with experienced advisors. They get the benefit of sitting in those client meetings. They're adding capacity immediately because they're highly competent in what they're able to do. They're coming out of school with CFPs and things like that. So if we can leverage that expertise initially, get them in the game, so to speak, it's a great way for us to develop talent and create capacity for our advisors in the field, which helps them serve more clients, generate more growth. So there's a lot of, I think from an investment standpoint on our end, we're really starting to turn our attention. We want to continue to execute on the core blocking and tackling experienced advisor recruiting model that we've always done. But it's really then starting to think about, all right, 5, 10, 15 years down the road, how can we be investing now to make sure our business has long-term sustainability? How are we developing talent? How can we start to look for ways to drive organic growth for our advisors? That's extremely important, right? Our goal for the end of this year on the assets under management side is $10 billion. So we need to add about another $2 billion of assets there. If we can do that through experienced advisor recruiting and we're able to, on top of that, start to compound at 15% organic growth, we're able to then hit our 3-year goal of $20 billion, right? And continue to kind of keep the momentum there. So I think what's a little bit unique about us is our ability to take a long-term perspective on things. We want to build a sustainable business over time. It's the same thing we preach to our individual teams that are affiliating with us. Take off your practitioner hat, put on your CEO hat, think about investing strategically. So we're very much aligned and practice what we preach in terms of helping our teams think about the future of their businesses.
And Merchant is an investor, all right, back
Yes.
here. So their confidence. What do they bring to the table besides for the investment?
Yeah. So Merchant was instrumental, right? So we originally took on the investment from Merchant in 2021. They originally bought 19.9% of our business that year. They ultimately upsized their investment as part of our move to the RIA space. So they brought capital to the table to help us facilitate that move. We have deployed, leveraging their capital, our own partnership and minority buy-in strategy, where we take minority equity stakes in the firms that affiliate with us. We give them cash and equity in our business in exchange for equity in their business. It's been instrumental in changing, I would say, the relationship from that of a vendor to that of a partner. And I think it was, instrumental in helping us facilitate our move off of the independent broker-dealer into the RIA space. What Merchant really helped us with significantly in that process was, when we chose Merchant as a capital partner, the advantages of it were that, one, it's permanent capital, right? No shot clock on the money, fits our long-term perspective. And I think this is probably the most important piece. The people within the organization. When you look at a lot of the partners within Merchant, whether it's Tim Bello, Rick D'Amico, Brian Staff, Matt Brinker, all of these guys, David Mrazek, came from early stage aggregators and consolidators and were operators, right? And they kind of flipped the side of the table and became investors. The strategic guidance that they were able to provide specifically as we worked to build an RIA and build a technology stack in a very short time frame was a huge part of the reason for our success and ability to do it. So I would say that the strategic guidance, the long-term focus, and then also, and I think this aligns very much with how we've always operated, this concept of minority non-control, not wanting to turn entrepreneurs into employees. That's how we've always worked with our teams. Merchant has the exact same philosophy. So it was really a great hand-in-glove fit from day one, but they were instrumental, to your question, in that move to RIA, everything from helping us design our technology stack to coming up with the capital strategy. Some of our teams had notes outstanding and financial obligations, so being able to come up with a capital strategy to solve for that. So across the board, they were a tremendous partner in that move and continue to be as we think about this next chapter of growth.
So you don't take controlling interest or majority stakes in the firms that on your platform?
Correct. So we take minority non-control stakes in the firms. It is optional. I think that's important. We talk about this concept of opportunity without obligation. The way that we position our firm is we are a platform for and a strategic investor in independent wealth management businesses. Those are meant to be looked at as mutually exclusive, right? And we want teams to evaluate each on their own merits. For the teams where our partnership model makes sense, we do take minority stakes. If we come across a business that, let's say it's a succession-related situation, we are going to be working with one of our existing firms on our platform to solve for serving those clients, right? Because us as a platform, we have 43 employees at the Concurrent level that are just there to support our teams operationally. Again, we're there to be the back and middle office. We're not ultimately serving end clients. So we will partner with one of our existing firms to assist them in completing the acquisition of that book of business. They're serving the clients. And the role that we want to have in that process is that of a co-investor. So we want to bring additional equity capital to the table. We can provide debt financing, right, through a couple different mediums. And so if we can act in that capacity, support that business, assist them with deal construction, ultimately transitioning it, it can provide a great succession solution to help one of our existing firms grow. But that's the seat that we prefer to sit in that type of scenario.
Okay. Let's talk a little bit more about the structure and the architecture here, and then we can talk about what you're seeing out there in the larger world of RIAs. But it sounds like what you're building is similar to, we've seen some of these models before, right, with like the Focus and some of the others. How would you differentiate yourself from those? There's various levels of success over there.
For sure.
On that.
Absolutely. And look, I think in a lot of ways we're standing on the shoulders of giants, right? Focus had executed on their buy-in strategy very well, successfully took it public, took it private, right? So we've been able to learn from and have been informed by a lot of what they've done. Our model is a little bit different. Some of the same themes, right? The advisor maintains full operational control. The primary difference in our model is that it is a true minority non-control stake. So we are owning common equity in their business, right? We ride the wave with them up and down. There's no waterfalls in place or anything like that. And so from our standpoint, we're investing. We want to invest in advisors who are growing, right? Also, I would say our willingness to buy a much smaller stake to start, to cement the partnership, is attractive for advisors at younger demographics, which is important. If you're in heavy growth mode, the idea of selling 40 to 60% of your business right now is probably a non-starter, but it's much more approachable if you're selling 10% of your business, right? So from our perspective, we're willing to, I would say, invest in maybe downstream of the typical firms like a Focus would have historically invested in. We're willing to start the relationship with a much smaller percentage. And our viewpoint is we want to find firms that we can really help move the needle from a growth perspective, and we'll benefit from that along the way. So I would say those are probably the differences from a Focus model. We do, often run into your more traditional roll-ups as well. We've seen, obviously, creative planning get very acquisitive as of late. The Mercers of the world, the wealth enhancement groups, have been at it a long time. Now, in those models, they're acquiring the full business, right? In a lot of ways, it's kind of put on the fatigues and salute the flag. From our standpoint, we want to maintain that dichotomy of, hey, you're fully independent, but you're a part of something bigger than yourself. We can create the upside that some of those roll-ups and more traditional aggregators create from an enterprise value standpoint without you having to sacrifice control. And so That's where I think we fit and why this model has been attractive. But by no means are we the only ones also doing this, right? We're seeing an uptick in this type of a model as well. And I think the competition's been great. You've really seen, if it was 10 years ago when I was operating in the succession and acquisitions group at RIA, the primary methodology for selling a business was sell it to the advisor down the street, use broker-dealer financing. I remember we would cap our financing option at 35% of the purchase price on a 5-year term at prime plus 2. The rest was on an earn-out, and that was the only deal structure. And you sold it for 2 times revenue, right? It was 2 times fee-based, 1 times commission. It's amazing how much the industry's evolved, right, over the last 10 or 15 years. And I do think the capital providers that have come into the space are informing strategy, and it's created a lot of unique opportunities that can fit different needs that advisors might experience.
Mm-hmm. So tell me then a little bit about who is an ideal fit for the Concurrent platform. You mentioned you're looking for maybe younger advisors or firms a little bit in their earlier stage, someone who's going to stick around for a while. Tell me about, when you're out there vetting firms or firms are vetting you, what are you looking for?
Yeah, I would say the traits, the characteristics that we look for are really entrepreneurial drive, right? Are they looking to grow? And again, do they want to build a business? It's not just in terms of asset gathering, but also in terms of expanding upon and improving upon what they're doing. I think advisors that are a great fit for us have a level of humility, right? They want to be a part of something bigger than themselves, but they want a voice in what that becomes. And we've instituted some different items within our business model. We have an advisory board that consists of 11 of our advisors that have active input into the overarching strategy that we're developing. We want to keep our finger on the pulse of that. So this idea of wanting to contribute to a community and having the humility to say, hey, I don't know it all, right? There's something I can learn from everybody else in this room. My job is to figure out what that is. I think that's a great archetype for us. We want every team that joins us, we want them to have a conversation with or meet with at least 2 of our existing partner firms, and we look at that as mutual due diligence. We say we have a no jerks policy, right? So we want to make sure that we vet out any firm that's considering us because we're highly protective of the culture that we've created. And it is a partnership, right? The vast majority of our teams, of the 54, call it books of business or practices that we have on our platform, we own minority equity stakes in 52 of them. So the vast majority of our advisors carry the common currency, right? Our equity owners in our business have a vested interest in making sure that we maintain our culture and that we continue to build upon the foundation that we have. So qualitatively, I think those are the most important things. When it comes to the quantitative side of things or the firm of origin, I think that's really grown and evolved. We talked about the expansion of the addressable market. Obviously operating in the RIA space, we're in a little bit of a blue ocean now. And so, what we're finding is that we're having success with firms across the affiliation spectrum, but they're firms that are looking to maintain their independence and autonomy, have an increased level of support, be able to stay on the leading edge from a technology standpoint. And I think to compete in the space today, there's a couple of things that have really become table stakes, right? You've got to have competitive economics. You've got to have strong transitions and operational support. At the end of the day, I would say that you've got to have a strong technology stack, right? That's becoming increasingly important. And you probably need to have an equity story, right? Those 4 things, to even be in a conversation, are table stakes. So then what differentiates us is our ability to go deep on, business consulting topics. It's, hey, you guys want to facilitate a merger and then come on board onto our platform, and then you want to execute on M&A strategy. Okay, great. We can help you orchestrate that, write your operating agreements, take you through that entire process of evaluating fit down to executing the documents, and set you up for success on our platform, leveraging our support and resources. So that's where I think we separate ourselves from the pack, is with those firms that are growth oriented. I don't know if the age demographic, I think we do tend to skew probably a little bit younger than the industry average, but I don't think it's a byproduct of age. I think it's a byproduct of the appetite for growth and desire to build something. And, we're not necessarily the highest payout on the street, right? But we think we do have a unique model, and it attracts firms that want to take that next step in their business.
Mm-hmm. Could you characterize at all the percentage of firms on the platform that maybe are looking to do their own acquisitions? Or would that be all of them?
It's not all of them by any means. So we actually have a program within our firm, we call it our builder program, where we have firms that are actively looking for sub-acquisitions or sub-affiliations. Mm-hmm. Some of those firms are Wealth Partners Alliance, that's out of Dallas and Houston, Family Wealth Solutions out of Sarasota, Legacy Private Wealth Partners, which spans Colorado into Kansas and Nebraska, Columbia Associates up in Portland, Oregon. So we do have what I'll call a hub and spoke model, where those firms are actively looking to add experienced advisors from a recruiting perspective, or might be looking to engage in M&A activities. The firm I mentioned in Atlanta, Limiter, is part of that program as well. And so we really wrap around them and supporting them in that model. We think we've found the right recipe of creating an attractive value proposition for a tuck-in advisor that they can go out and deploy. And where they create a tremendous amount of leverage for us is they're typically investing in the local infrastructure. So they're building out office space, they're hiring support staff. So what you end up with is Concurrent as the back and middle office, a firm like Wealth Partners Alliance or Legacy as the front office. They're providing the local office space, the local brand, the sales support. And what it does is it creates a nice tuck-in environment, which I think it can appeal to advisors across the affiliation spectrums, but really wirehouse breakaways who are looking to have the conveniences that they were accustomed to in an employee model, but the economic benefits of independence and all that we can offer in the multi-custody space. That's what is really the target advisor for those models. So I would say that we have a group of firms that are doing it in a scalable and repeatable manner. We want to expand that group. So that's an active initiative for us, is to how do we find more of those firms out there that we can start to plant flags with and really come alongside of them to build in their respective markets. And then we have individual advisor teams that are just looking to acquire other books of business that might not be trying to build out office space and recruit, but are actively looking to grow through acquisition, provide a succession solution, and we can support those firms as well. And so I think we have advisors that kind of fit all of those, and we have some that are focused on purely organic growth. So we do have advisors across the board. I wouldn't say all of them are actively looking to grow inorganically, but for the ones that are, we do have a model for that, and we deploy a tremendous amount of resources to assisting them in that process.
When we talk to a lot of RIAs these days that are participating in the M&A market, it seems like it's transition just from like trying to get more money in the door. They will partner or buy or be bought by firms that complement their service offerings, right? So it's not just, I don't have estate planning, so they do, and
sure.
So we'll, is that some of your thinking as well in terms of service providers and where maybe the pieces of wealth management kind of fit in to the overall structure? I mean, would that guide some of your thinking in terms of who belongs and who doesn't?
Yeah, we're definitely thinking strategically around our next acquisitions and looking for ways to expand the scope of services our teams can provide. Tax planning is another horizon here that we want to address. Family office services. A lot of our advisors are working with high net worth and ultra high net worth clients that are looking for a one-stop shop, so to speak, that covers tax and concierge and real estate management and bill pay, right? So we are in discussions with a number of firms that operate in that space that could complement our existing asset management, financial planning, risk management offering to create that holistic structure. So I do think that the way that we will expand into that market is through acquisition or minority acquisition. We're very open to a lot of different forms there, but I do think it'll become mission critical in being able to continue to have a defensible fee structure and serve clients over the next 10 years. I think we're going to have to do more. Now, that being said, I don't think it's a more for less situation from a fee compression standpoint. I think it could be a more for more situation where if we can deliver more services and more resources, it's a way for us not only to defend fees, but to be able to provide a much more holistic experience there. So I think we would achieve that through acquisition. We've also achieved it through, in some recruiting efforts, we've brought in firms that have unique individual expertise. We're in discussions today with an asset manager about potentially acquiring it that also has a private wealth business that could be an interesting strategic acquisition to bulk up the investment side of our house. We're I would say very much acquisitive and very much focused on how do we continue to build upon the foundation that we have, but while also making sure that we're scaling the core resources, right? The blocking and tackling, the operational support, investment ops, compliance, so forth, to make sure that we're ready for growth as well. So we don't want to take our eye off that ball, but absolutely focused on the next chapter and how we continue to expand upon what we're delivering.
So I'll throw this out there because I know it's a topic that gets bandied about a lot, but one of the reasons that M&A is so prevalent in the RIA industry is because largely, and some people have a different view, and I suspect you do, and I would love to hear it, there's no more organic growth to be had. True organic growth is minimal at best. In fact, for most advisors, probably dropping.
Sure.
How do you feel about that? Is the M&A game just simply kind of propping up the entire boat, or how do you feel about organic growth?
So organic growth is an intense focus for us. So we've made a couple of key strategic hires. We have an interesting structure in that we have the large corporate retirement plan business, in addition to I'll call it our retail business that has been propelled by inorganic growth opportunities. what we're looking to do is leverage the existing relationships we have on the institutional side of the house, because when you look at that business, there's over 110,000 individual plan participants represented across the plan sponsors that we serve. So as we think about this next chapter of organic growth, we see it in a couple different pieces. One, we are actively looking to deploy financial planning, financial wellness resources to those plan sponsors to create connectivity between that side of the house and our retail business. Now, that being said, let's say you have a plan sponsor that has 1,000 employees, right? Of those 1,000 employees, there's going to be 500, 700 that are rank and file, may not have the investable assets needed or that our advisors would want, right, from a growth standpoint. But in order to fulfill our goal of providing a holistic financial planning solution to that plan sponsor, they need to be served. So the way that we tackle that is with technology, right? We have a partnership with Tiffin at Work to provide an AI-enabled solution for plan participants. But we also are actively hiring for our centralized planning team because we look at that as a great training ground for new advisors. Right? One of our goals is to train and develop 100 new financial advisors over the next 5 years. We need to develop talent, right? That's what will determine whether firms can grow organically and actually be here 10, 15, 20 years down the road, right? Which I intend to be. So from that perspective, if we can leverage those opportunities to be able to provide financial planning support to those participants who need it, right? We're able to use technology to scale it more appropriately. And then as we work up the hierarchy of those organizations, we then start to use higher level team members within our centralized planning team to support the middle management structure and the VPs. Then ultimately, when we get to the C-suite and senior management level, that's where we're looking to put leads on our advisors' desks, right? And so we think of that as a great opportunity for us to develop talent and help drive organic growth, leveraging the relationships that we already have and providing a solution that those plan sponsors ultimately need. We're also actively looking at forming relationships with different affinity groups, networks of CPA firms. We think about the acquisition opportunities. If we're able to acquire firms that are operating in the tax planning space, that can present, I think, leads and opportunities there as well for our advisors. And so from our perspective, we're investing very heavily in organic growth. I think there's a whole another chapter of where that goes. I don't think it's done. I also think that when you think about the generational wealth transfer, right, over the next 10 years and money that's going to start to flow down and being inherited, we're going to have to engage with those clients in different ways. So I do think that organic growth in the traditional sense of, driving referrals from existing clients and replicating your top clients, I think it's something to continue to focus on. But I do think in order to be successful in growing organically, we're going to have to be thinking about how do we engage with clients in different ways? How are we using technology to make that more efficient, right? How are we appealing to that next generation of investor? I think that's going to become very important there. And at the same time, we're not immune to the demographic challenges that our industry faces, right? So we need to be developing talent now to be able to provide succession solutions for our firms 10 years from now, 15 years from now. So I think the firms that figure that recipe out will have a tremendous amount of success. And I do think there's a lot of firms in the industry that have continued to grow at impressive organic growth clips. We want to be known as one of those firms. So not something we're throwing in the towel on, something that we're very much focused on.
I like this idea of developing talent, 100 new financial advisors over the next however many years. So another thing that when we talk to a lot of advisors around their growth problems, what's holding them back is the ability to find talent. And so tell me a little bit about how what your plan is for these new advisors, and how you're going to do that.
Yeah, absolutely. I do think a lot of it is around we're building new advisors, right? So we are hiring folks that are out of school or maybe have a couple of years of experience in different industry groups. Maybe they started an insurance BD or a bank program or something like that, and they have some experience in working with clients, and we're able to bring them in. Or maybe they're coming out of a financial planning program, like Texas Tech, for example, and they've had some internship type experience. They're coming out with a high degree of competency. Maybe they have a CFP even, or at least have passed the test and need the work experience. And so what we're looking to do is how do we leverage their competency, the talent that they already have, to help move the needle immediately, but still give them the time to develop, because it is such an apprenticeship business, right? And I think that's what has caused the talent gap in our industry. It's a lack of patience. And so if we can bring these folks in, we can start to train and develop them. They can help help immediately by having a more specialized role, whether it's in the investment team or it's in the financial planning team, where they're doing financial plans for clients, but they're having the opportunity to then sit in the meeting, right? And they're seeing the interaction between an experienced advisor and a grieving widow or someone who's looking to take their money out of the market and they're trying to hold them back from their biases. That's the stuff that, you're not learning in a textbook, but they need exposure to. And so if we can find ways to leverage their current competency and expertise and put them in those situations where they can get that development from an apprenticeship standpoint, it will give our experienced advisors more capacity so they can go out and focus on prospecting, they can go out and focus on serving their clients, but at the same time, it allows them to ride shotgun and get that valuable experience. So from our perspective, I think it's really a new hire situation, and I would say that it's not being afraid to look at new grads and more younger, less experienced people in the industry that can learn our way of doing things and develop in that capacity.
So you bring them into the home office, so to speak, and then deploy them out to the teams on the platform as needed, or
that's the goal, right? Mm-hmm. It's actually been interesting too. We've had a number of our firms, and initially it's been sons or daughters, right, that are coming into the business that they're saying, hey, I want them to cut their teeth somewhere else before they just join my practice. And so we've gotten some talent has come from the field where they come into the home office, they work within our team, and then ultimately the plan is to deploy them back. Also, as we're developing folks and hiring folks, the plan would be to deploy it into the field. But as we talked about before, if we're going to be here 10, 15 years down the road, I think we as Concurrent need to be able to provide a succession solution. And because we are equity owners in their business, I'm indifferent as to whether or not it is a homegrown team that is acquiring the book of business or that we're deploying them into the business. The main goal is that business survives on and continues to grow. And if we can build talent and deploy it as an investor in that business over the long term, that creates sustainability. That's attractive for us. So I would say that, as we, over the next 5 years, as we're building and evolving this program, I think time will tell what the best outcome or solution would be, but no aversion whatsoever to deploying that talent into the field because we have aligned incentives in doing so through the ownership structure.
Mm-hmm. It makes sense. I know we're kind of bumping up against our time here, but just a couple more questions. You personally, how much of your time is spent vetting potential partners or acquisitions and investments versus building out the home office versus keeping your eye on inside that?
I would say over the last 18 months, months 1 through 12, we're almost exclusively focused internally of how are we reorganizing our team, what hires are we making. I'm a big believer of let's go find really smart people and have them tell me what to do, and that's worked pretty well to this point. So it was a crash course in organizational leadership and change management. Now that we've, I think, gotten through that phase, the platform is operational and we're up and running again, it started to shift back towards growth. But we've also been able to hire some really phenomenal talent on that side. We brought in Joe Mooney, who came on board. He ran East Coast sales at Fidelity. Previously, it was at Schwab before that. And so he's done a phenomenal job of kind of taking the bull by the horns on the business development side and is ultimately been able to take a lot of the blocking and tackling in that area off of my plate. So it's allowed me to take a step back and start to think more strategically about acquisition opportunities and where we're taking the business in the next chapter. Going back to my background, though, I was always in recruiting. I was always in M&A. So if left to my own devices, I gravitate back into that. But it's been much more balanced now that the platform is up and running. We've got the right people in place to operate it.
And how many employees in the home office now?
43 employees in the home office, 101 advisors. They have about 150 staff. Okay. So when you look at the total ecosystem, we're about 300 people within the Concurrent family and community. So and we expect to continue to hire, I think, fairly aggressively here over the next 12 months so that we can, again, uphold our service levels as we look to achieve those growth targets.
Sure. Just a final question, just from your experience in the M&A arena, I guess the thinking at the beginning of the year, maybe like a year and a half ago, was that it was all going to come tumbling down. Interest rates going up, economy's kind of wobbly. It's, M&A is kind of on its last legs. We haven't really seen that. There's still a lot of activity out there.
Sure.
What do you think is just your high-level view on the M&A market in general, and how it's transitioning or transforming at all, if it is?
I still think there's a lot of opportunity there. I think it's forced acquirers to be more disciplined, right? When we're in a high interest rate environment, obviously cost of capital is higher. That's going to impact multiples to some degree, or it's going to force you to kind of extend yourself in terms of your leverage ratios and so forth. I think what's the firms that will continue to do this in a repeatable manner are, have the right capital formation, are well capitalized, are able to deploy equity capital in a meaningful way. If you're facilitating it primarily with debt capital, right, you're going to start to become range bound in the multiples that you can pay. That being said, maybe you should be, right? And that's where we are in our model, because we are taking minority non-control stakes. It allows us, I think, to be very disciplined in what we're paying for businesses versus having to overextend ourselves to be competitive. Most of our conversations also evolve organically, right? So we're not typically engaged in a banking process where it's an auction process for a firm. From our perspective, we're working to build relationships early, demonstrate that we can add value and help them think about the next step in their business, and then come up with a creative capital solution to help them get there and lend our playbook as well to what we've done. A lot of the firms that we're actively talking to are OSJs that are looking to make the next step to the RIA space, or firms that do want to become a builder firm and want to grow and recruit. We've been able to do that very successfully. We've had the scraped knees, like I mentioned before. We can, lend our experience there and help them through that. So I do think you're going to see, I think we're already seeing multiples, right? I would say in the middle of the bell curve, right, start to stabilize a little bit. You still have the far end extremes, right? And I would question the firms that are out there doing acquisitions at the 18, 20x type level. It's okay, unless you're able to drive meaningful strategic growth, right, how are you justifying that price? So that's where I think discipline will win the day. But to your point, there's still plenty of opportunities out there. We're seeing plenty of deal flow. So it hasn't necessarily slowed down. It has gotten more competitive, but the world that we tend to play in, again, is not typically the full sale auction related process. Yeah. It's growth capital.
And you said earlier that you might not be the top
Correct.
Valuation, but overall in general in the industry, we have seen valuations kind of contract.
Yep. Yeah, and that makes sense. And I think you see that because of, again, where interest rates are. I know the tone has also changed right over the last month. Are we going to get another interest rate increase here? So I think that will continue to, quell some of the exuberance around doing deals, but also the number of deals.
Higher quality, fewer.
Exactly.
Quality.
Remain disciplined.
Yeah. All right, well, this has been fantastic. I appreciate it. I know we're bumping up against the hour, I know. But thanks very much for coming in.
Absolutely. It's been a lot of fun, and happy to come back anytime.
Absolutely. We'll do it again. Okay, everyone, so that was it. Thanks for listening to the conversation. This is the RIA Edge podcast. I'm David Armstrong. As always, feel free to reach out with any thoughts, questions, comments. david.armstrong@informa.com, and thank you for listening. Schwab Advisor Services is a proud supporter of the RIA Edge podcast and independent financial advisors like you. When it comes to your independence, Schwab Advisor Services is all in. They provide industry-leading custody services with no AUM minimums, no custody fees, and digital onboarding for starters. With Schwab, you'll be backed by some of the most passionate folks in the industry with over 35 years of experience helping firms of all sizes. To learn more about everything Schwab can do for you, visit advisorservices.schwab.com.